I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
May went out with some selling following 5 green months for the market. The volatility continues in Japan as some world markets continue to correct. Will our market see its first down month in June? I'm Brittany Umar, and the morning call starts right now.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. So futures are pointing to a higher open this morning after the late day weakness that we saw on Friday. The S&P dropped below its 21-day and closed below it for the first time since late April. So now the question is, what can we expect this week?
Well, the futures being up today are probably frustrating some who maybe pressed the short into the close, but we did have a big travel range. But the futures also opening up a little bit is probably giving traders who weren't here on Friday, because it is the summer and sometimes people take off a little bit early to do a race or something. But in general, at this point, I think that the market's at a bit of a complexion or a key composure point where, we had that outside day almost 2 weeks ago, which was a spot to take off some risk. And then we had a range to maneuver, which for traders was welcome, the volatility there. And then on Friday, last hour, you saw that selling. You saw a break below 1645 in the SPX. You saw a break below 1640 to 1635. And now the question is, do we retest that area before heading to potentially, the 50-day moving average, which I think both the bulls and bears would welcome.
Right, so that's the level that we should be watching then this week, correct? The 50-day?
Well, first, let's see on this bounce back if it's contained. If you look here at the chart of the S&P, you'll see on the SPX that, ever since we started the year, we've been in this very gradual trend. Okay, we had few minor pivot point corrections, one being right here in February, didn't amount to much. This one being another one in April. Remember that breakout failure that wound up leading to a correction about 4% or so to the 50-day, and then we had this really big move to the upside. So here is that outside day on that Wednesday. Remember that day and a half big move, about 3.3%. Then you put a lower high, higher low, lower high, and then finally on Friday, you had a little bit of a range resolution where we closed on the lows. Some people are calling it a rebalancing. Some people are thinking that, could have been some headlines about SAC. Who knows what they were thinking? The bottom line is we're up a little bit right now. So with that being said, I would say you have 2 resistance areas. One is 1640-ish, which is a spot where we are right now, where some traders will look to re-short if they covered into the close or if they missed, Friday's down move. And then you have resistance 2, which is right around this 1648 to 1652, which would be the line in the sand. If the bears and the sells want to see the 50-day moving average, which I'm thinking we could see, they don't want to let the market reclose above 1650-ish. That would be that line in the sand.
In May, we talked a lot about how it got frustrating to stay with an extended market, and especially at the levels that we had seen for intermediate type traders. So do you think traders are welcoming this volatility?
Yes, I am, and I think a lot of guys on the desk, because anytime you have a market that gets extended from the 8-day moving average, it's hard for risk-averse type traders to stay with it. And I know for me, I've been trying to be in portfolio approaches. The market's been conducive for it. But once you're up 15% or so in the S&P and extending, for me, I trimmed and trailed my way out of a lot of good positions, and it was getting frustrating to see them so much higher. So this could be like your refresh, where hopefully the volatility is tradable so you can make money both long and short. And then once we see a pivot spot, to buy, hopefully it'll be that 50-day moving average. Then maybe you could put some more intermediate trades back on that you could swing and stay with and not feel like you're chasing an overbought market, which we had for, weeks on end.
Well, you showed us the SPX, so why don't we get a visual then of the spiders and the levels to watch there?
Okay, well, the spiders tracks the SPX, but a lot of traders that don't trade futures, they trade the spiders, so that's a good thing to look at. So you look right here at the spiders, and you will see that here was that outside day, also that Wednesday when we pushed above this level here of 167.80, put in the pivot high of 169. here was your reflex low above the 21-day, your lower high, and then if you remember this wedge pattern right here, which is also aligns to, you know, this accelerated trend, broke below. So I would say right here, I know pre-market, we're retesting this break of 164.25-ish. You know, if they push the envelope the way the market does, perhaps they push it a little bit higher, so that's like 165-ish. So this would be the zone that the bears here have to defend, okay? If today we open up, start fading and trade through Friday's lows, I think that'll give us some confirmation that this 50-day should come, you know, maybe even quicker, but by Wednesday, Thursday. You know, but we have two days to get through. Today is the first day of a new month where some managers get new money to put to work, so there could be some strength from there. And then you have that Tuesday streak, right? 20 for 20.
Right.
So I would say in the next 2 days, if this market doesn't bounce back with any kind of force, I think the sellers will have conviction to take us down to the 50-day moving average across many of the sectors.
Well, if we check the temperature then across sectors and look for clues about which way the market will head, perhaps we should look no further than the banks, which was the strongest group, led the market up over the past 2 weeks and didn't even go down to the 21-day. We saw it still at the 8-day.
Right, and this has been because they're talking about when rates go higher that the banks will have more business to do, which is true. And we've been talking about the banks also, but entries and exits matter and so do patterns. So right now you look at the XLF, you will see here's that outside day, didn't get to the 21-day. It's been holding the 8-day, closed on the lows though on Friday. So do we get an inside day and do we hover here? That would probably mean that some of the sell-off will be contained. But if we all of a sudden go red in the financials first and take out 1983, you know, move to the 21-day, as this is coming to the 21-day, I'm sure some of the weaker groups will be heading to their 50-day. So we'll see what goes on here in the next session or so. And, you know, I would also watch just your Goldman Sachs as, you know, it did have a bit of a push-through failure and it's very extended. So maybe some traders will look to see if this, you know, goes red first, because some people that have been hiding here might say, okay, it's time for some corrective activity in the banks, and this will help give us some clues on that with JP Morgan and some of the others.
Well, speaking of groups to watch to see if they reach the 50-day, the home builders, the XHB is now below the 8 and 21-day, so it'll be interesting to see if softness there continues.
Yes, and it seems like the few times that we were ready to roll over a little bit, this became the weakest group, and then all of a sudden just snapped back and forgot that it was weak. But anyway, short term, you know, if you look here, you'll see that it's below the 8 and 21-day moving average, you know, and these are now pointing lower and rolling over, so that's going to be some resistance. If they could stay, if this group stays below 3130, 3150, I would think that this is probably one of the first groups, you know, besides, you know, the utilities and whatnot that make it to the 50-day. And then, you know, right around here, there was what, 3 other times? One time it went through the 50-day, reclaimed it, 2, 3. So this would be the 4th visit that, you know, that could be buyable for those looking to buy the dip there, which I do think it should be.
And the transports have been weaker as of late. The next support level is around the 50-day. Do you think we might even see them break below this?
We'll see, because that also coordinates to a pretty big trend line in the transport. So if you look here, you'll see that you know, this low that was here in November, you know, it's been tracking it and holding it, and here it is right there. So this little mini head and shoulders top pattern, which is a micro version, you saw the same one here, okay, before it actually had some corrective activity. Here was your left shoulder here, your head, your right shoulder, it broke, held the line though. So here, you know, it's already starting to go a little bit below. See if maybe if they sell us off today, maybe this goes red first and then gets to that 50-day again, and then we'll have to see, does it hold this trend line that's been holding since November, or does it break it for some type of real correction? That's what we're trying to figure out. Is this just a pause or something bigger? And I think the transports could help with some clues.
And the industrials, on the other hand, showing some relative strength, holding above the 21-day. So what do you think this says about the composure of the strength of the industrials?
Better than the transports.
Right.
So, you know, we'll see, and we'll see if that continues. You look here, and you'll see you did have an outside day again, you know, right here. This was your first one, you know, on the same day that most indices had it. It is above the 21-day. So we'll see, you know, if this goes red, you know, here's a 21-day, and then here is, you know, here's your 50 days. So, you know, map it out. These are the levels here. These are, you know, you're trading intermediate or you're trading daily. This is what you have to know. I would say if they want to keep this weak, they keep it below 44. And if we break below Friday's low, here's your 21-day. If that doesn't hold, there's definitely some room here for more corrective activity.
And over in the utilities, the XLU already dropped below its 50-day. So how low can this one go?
Well, this is unusual because a lot of money hit here when they all wanted yield, and then this started to break down first, giving us some clues that maybe the Fed would start raising rates, or just the market would raise rates for it, and that's what took place. So you look here, and we talk about head and shoulders patterns and reaching the measured moves, and it hasn't happened a lot in this market because necklines have been holding. But if you look here in this group, this had a head and shoulders top. Left shoulder, head, right shoulder. Here from 41 to the neckline of about 39 and change. This was the measured move, and now it's at the 200-day. So the question is, does this, now if the market corrects, does this turn into a defensive area to buy, or does this, because it's so relatively weak below the 200-day, does it continue to show relative weakness? So I would say use my rule about the 200-day. If it stays below the 200-day for 2 to 3 sessions, that shows you real selling, and it can go higher. If it comes back above and puts a little tail here and then starts to get above maybe this pivot, that'll show you that this was a nice little corrective move to buy. I'm not looking to buy this utility or this index just because I don't specialize it, but if you want to diversify your portfolio and you wanted it here and you sold it into strength, this is probably a spot to dip your little toe in if that's what you're looking to do.
All right, well, we can also keep an eye on the bond ETFs. We're going to go in the trenches with the TBT and TLT, but first, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Last week, we talked about Scott's thesis about going long the TBT and short the TLT. So now, how does that thesis come into play this week, given the action we saw on Friday?
Well, a few different things. Depends on your time frame. I talked about being long the TBT and short the TLT, as a position probably for the next 6 to 18 months if you don't watch it, because short term it's a little erratic. Longer term, I think that thesis holds true because I do think that rates eventually are going to go higher and higher than they've already gone. I think there's now talk that September 18th Fed meeting is when they're going to go from a pace of purchase of 80 billion or so down to 50 billion. So we'll see. If you look though at the chart of the TBT, still having a little problems here. Okay, this 70 is big resistance going sideways. If you remember that big, that strong jobs report, that was your gap up right there. So here was one micro area that it was acting pretty poorly going into May, and then you had the gap up, and from there it's been a really nice move. Following the 8-day moving average this entire time. Looked like it was going to get above it Friday, then kind of sold off towards the end of the day. I would say, if you have a portfolio approach and you're looking to be involved in something that could benefit as rates go higher, I do think that at some point it's going to get above this 70 and hold it, and you could see something north of let's see where the next really I think this gap gets filled somewhere into the 80s, and that's something you could put in your portfolio, because if you look at the TLT pattern, you will see a very bearish long-term head and shoulders pattern that does take time to work out. Okay, here's your left shoulder, here's your head, here's your right shoulder. It's already coming a lot from 125. That's why it could be tricky as it bounces around at major support. If you take a close look at the micro version, it's having a hard, remember we talked about it could bounce back up to 116, 117, couldn't get there. Looked like it was going to break lower, and then the end of the day, money just came there. Overall, if you have a macro thesis, I think you stay short this. If you're trading it, just know your levels and know how many days out you're looking that you could, take the risk of something like this, because still 124 down to 114 is 10 points. It's below all the moving averages, which is very, very bearish. The pattern typically works out over time, but I think this is something more you put in the drawer and forget about versus, trying to, do the day-to-day activity there unless you're an ultra professional.
Well, checking in on the metals as well, the GLD was able to hold its double bottom area of around 130.50-ish, but it's still struggling to find momentum.
Yes. You know, to me, I still think this is a broken trend. I think eventually lower. For those on the intermediate level, like we go back and forth. You have intermediate, macro, then back to intermediate, back to macro. And if you look here, we talked intermediate first, right here. If you look at the chart and you remember, you know, right around this triangle point, I'm like, this is an adjustment area. You know, if you have a thesis on gold, great, have one. But on an intermediate level, it's either going to break above 162 or break below 160, and it broke below 160. A lot of macro guys out there were like saying, well, it's come a long way, it's come a long way. So I said, okay, here's your macro level. Okay, if we break below this 148.5, you know, I know it's had a sizable run, but why not protect some of it? You know, and you look at support going sideways, there is that macro. Okay, so now it did come in, held the support that we somewhat outlined, and now it's trying to consolidate again. And look at this mess. Okay, all of a sudden you can have another triangle type pattern here. This is your double bottom, 130.50, 130.50. You know, looked decent here and then engulfed it. Now it's opening up a little bit. I'd say intermediate term, here's a point of reference. It starts getting below 132.80 again. Maybe you start cheating short, because if it breaks 130.50, you know, you're gonna have a long way to go underneath it. If it continues to hold this micro level and go sideways, maybe, you know, it breaks above this intermediate downtrend and tries to bounce. But ultimately, you know, it's either you got to be very, very, you know, hyper scalpy with this, because every other day is very random, so more like intraday, or say, you know what, I think gold is going there. Here are my macro levels, and if you were macro long, you save some money selling at 148.5. If you cheated when it went below the intermediate at 161, you really saved yourself some money. But, you know, people in gold, they have very stubborn tendencies, because I don't know, they made, I guess, that much money on the last decade rise, but, you know, just don't give a lot of it back. There's no reason to. You could use levels here versus opinions on why and what should happen in the gold market, because a lot of those reasons that people thought it would go up with months ago didn't, and then when things don't go up when they're supposed to, they typically go lower, and that's what's been going on in gold.
And what about silver now, which has been trading below all key moving averages? Is this one that you would just avoid for now?
You know, this is even more frustrating than gold. The range is even that much tighter, so the intraday move isn't even that much. So, you know, I'll just real quickly go into silver here. You take a quick look here. You know, you still have this huge gap that it was not able to fill. You know, you know, this is almost right back to these lows here. This to me does not look good, and something that I haven't touched in so long. So, you know, take my lead. Usually, you know, I'm pretty decent at finding out where the action is, and it hasn't been in silver unless you're just leaning on this short. And if you are, you know, congratulations, because it's been a big move since this intermediate, you know, break of 30 down to here.
All right, let's do some quick hits here. Tesla providing great two-way opportunities for active traders in the past couple weeks. Where might we get some more opportunities?
Well, you know, both ways it's been very fast and very active, and it feels like the whole world is talking Tesla now. So usually when that happens, it gets corrective. And last week or last Wednesday, we had a gap up right here. Okay, last time we had an outside day, it was right in this area of the range, and what it led to only about a day and a half move. It held above the 8 day, and then it went really tight. And remember, right around here is when the market was getting weaker. This got stronger, gave you a 3-day up move, and then on the 4th day, this was your outside day. Opened up, traded below 110.75. Some said, I'm going to short here versus the highs, beat me. And if you did that, you know what, you're sitting in nice profits. You've been trailing it as a swing trader. Some people just do it as a day trade, whatever. So on Friday, we started talking about how if Tesla breaks below 101.20, you know, it could then see 99, and I know Evan was all over this trader trying to be short. Congratulations here. And it closed right on the 8 day. You know, last time I went to the 8 day here, it reversed. Maybe today, you know, it looked lower this morning, but now it's up a little bit. Use this as a pivot, okay? This is today's pivot for this stock. I wouldn't look at opinions or whatever, look at pivots. 97.73, if it were to break below, come into this area and hold and come back above, maybe then it continues to go sideways. I'd say this time it needs time. Take micro scalps in this one, because micro scalps in this one could be, you know, $2 to $5 at a clip if you're right. On a macro level, you know, it just had a huge move. I guess you could draw like a little bit of a trend line here. This would be pretty important, which again comes in right around this, you know, 94, 95 area. And then here's your 21 day, which another, you know, scenario to write down there.
All right, and Apple did show some relative strength late last week, but sold off into the close on Friday. What level would you say it needs to hold to make sure upside momentum stays intact?
You know, this is like the tale of two patterns right here, where you have this inverted head and shoulders pattern that's trying to build. It was strong on Friday, went as high as 457 before finally, you know, giving way when the market sold off. So at this point, it's still Apple. It still has a lot to prove, which has been the new thesis for Apple ever since topping out at 700 back in September. So if you look here at the pattern, here's that little left shoulder. Here's the the head. Here's your really well-defined resistance where it fell short of a little bit here, but then you do have this little you have this extending channel here, which when you look at it, sometimes you don't want to see that type of thing break. So right here, I would say the longer it stays above 450-ish or 448, I think the higher the probability that we do bust through here as we get closer to its event next week. But if it starts to break below this trend line here, I think some would start to lose faith like me and say, okay, it needs more time to build and it's not an A trade again. So at this point, Apple has been frustrating, but there is some opportunity for the active trader. And if you're trading it from a macro sense and you bought it when it reclaimed this 420 area right there, that would be an area I would use as a stop from a more macro sense. And here is your intermediate, and let's hope maybe it could buck the market trend, or if the market hangs around, that it breaks above this, Friday's high, which was 457, and then gets a little bit better. It would be nice for traders and investors to see this 200-day again, but again, we need to measure it along the way.
All right, and going back to the banks, the leading group, best in breed in a leading group, Goldman Sachs, is showing signs of exhaustion after the big move that it's had recently. What are the levels that you would watch?
Goldman I showed in the beginning, so I'll just quickly show JP Morgan. You go to JP Morgan. This has been a very, very strong stock, from breaking out above 50. First, little king and queens formation where you have a green day matched by a red day. It's probably up a little bit, so I would say, watch this. If JP Morgan were to break below yesterday's low or Friday's low of 54.59, you could see a quick little cute scalp to the 8-day and then see if the 8-day, which it's been riding this for all of May, see if that continues to stay intact. So 8-day gives way, then maybe the market comes in a little bit more and you get your rare push to the 21-day, which doesn't happen that often lately in the banks.
And Google's taking a break after the big run that it had. It is hovering right around the 21-day. What if that gives way?
If that gives way, then I think the 50-day and the prior high. So if you look here at the chart of Google, you'll see that here was that descending channel right after earnings. It broke above, followed the 8-day for a while. Then a lot of traders were trying to figure out whether this flag up here would hold to new highs, and it failed. You had one little sign here when it tried to go and didn't. Then this was your stop around 900. Now it's trying to hold the 21-day, and the 21-day hasn't given way in a long time. So some traders are probably trying to find a little bottom there. And if the market's going to hold in there, maybe this holds. Okay, so I would say write down two levels above 878-ish. Perhaps you see some type of bounce. Okay, which could happen. Why not? It's Google. Google's been one of the best in breed high beta techs. Or if it starts breaking below and the market gives way, 864, then I think that we do get a retest of this 844, which at this point I'm sure the 50-day will move up to, and that's something that I would be very interested in putting in my swing account if we can see that. Otherwise, I'll just probably tactically trade it here and there.
Well, it is a big week for data, culminating, of course, with non-farm payrolls on Friday. What will we be focusing on heading into the first trading session of the week?
The futures are up. Let's see if they push the envelope. If sellers will probably come back and try and see if Friday's move is valid. If Friday's move is valid, S&Ps probably don't want to be above 1643 to 1652 in the next two sessions. I'm going to watch to see how the market handles today and tomorrow. If this bounce lacks energy and the banks get sold a little bit, this and that, that'll give me a little bit more conviction that we will see the 50-day. I've already taken down a lot of risk and been trying to tactically maneuver these ranges. A lot of people on Wednesday, I think that's when I said either Wednesday or Thursday, I'm like, gun to head, probably see 161, which is around the 50-day before seeing new highs based on the complexion. So some people took advantage of that for Friday. I bought some, on the virtual trade floor, so I bought some puts, I think on Thursday, added some midday Friday, then on the close, I sold the other end of that spread. So if we rally up a little bit more, just say up to 164.5, 165, I'll probably take off the 162s that I sold to make the put spread, and then if we get some weakness midweek and we go back down through Friday's low, maybe either I'll put those back on and I'll trade around it. So there's a lot of trades. We're allowed to do trades here, and at this point I think traders welcome having some volatility versus just sitting and the same old grinding, which at a certain point gets hard to do because we were definitely overbought for a considerable amount of time.
Of course. All right. Well, thanks so much and happy trading, everyone. Have a great Monday.